What's going on with gold and silver?
Well, it's waiting to see what happens to, President Xi and the PLA. Well,
Okay.
gold did what it did because next year in May, as you know, there was a lot of people worried about an invasion of Taiwan. The government can always buy its bonds back and has been doing so, even though technically it's illegal. Gold is for war.
Very interesting. Okay. The S&P 500 continues to grind to new all-time highs. Meanwhile, the UAE is leaving OPEC, and Jamie Dimon is warning of a bond crisis. We'll find out what's next with the entire global economy and markets. Clem Chambers joins us once more. He is the founder of ANewFN. Welcome back to the show, Clem. Good to see you as always.
Great to be back.
Happy Tuesday to you. So let's start with a warning from Jamie Dimon of JP Morgan. Warned that rising government debt levels could trigger a crisis in the bond market, urging policymakers to act before markets force their hand. The way it's going now, there will be some kind of bond crisis, and then we'll have to deal with it. I'm not that worried we'll be able to deal with it. I just think maturity should say you should deal with it as opposed to let it happen. Very ambiguous warning, but ominous nonetheless.
Well, it's a very accurate warning. Of course they can deal with it. Of course it has consequences. And they will deal with it, and it will have consequences. Inflation, during COVID and early on in your show before inflation showed up, I said inflation's coming, and then it arrived, and I said, I'll get it down now, and they got it down now. It's coming again now. It's going to be at least as bad as the COVID inflation, and it's going to go for a lot longer because it's not going to be inflation created to pave over or, paper over something that lasted 6 months. It's going to be there to fund a massive industrial build out or an attempted build out by America. Massive build out. Plus this monster of AI, which is another huge build out. You're talking about trillions of dollars of money, liquidity, cash, that it was going to be needed to fund all this. They're not going to say, oh, no, we haven't got the money to fund this. We're not going to print this. No, we're just going to sit here and shrill away. They're just going to pull the lever and they're going to pump it out. And fortunately, it'll go into productive assets, which means that it won't be hyperinflationary, but it will be high inflation. You're going to get inflation of 7, 8, 9% for 5, 6, 10 years. And it's here and it's arrived. And, when you're fed, your new Fed man says, oh, we've got to get deflation. I mean, that's not because he's on Planet Zog, high on drugs. It's because he's saying that so he can inflate, so he can lower artificially interest rates, so he can print money. It's going to be a printathon coming up to an economy near you. And for the economic active, that's great news because, you surf that huge wave of cash and you get loads of it yourself. And for the economically passive, you get crushed.
Which assets have historically done well during times of persistently high inflation, not just a spike, but several years of higher than 3% inflation?
Well, there's good inflation and bad inflation. Yeah. There's stagflation, which is really bad inflation. There's inflation, which is just there and nothing much is going on apart from it's eroding the value of your money and eroding the liability of the government, which is not great inflation. And then there's the inflation that creates economic activity, which you can put up with because, your money goes up 10%, even though the actual value of it goes, the amount of money you have goes up and the power of it goes down, but overall you're better off, right? And there's been many cycles where inflation has run alongside people getting even more money than the inflation. After COVID, although most people have forgotten this and don't believe it, but in America, wages outran inflation at the beginning of that cycle. And that's a good example of a business that runs hot because of inflation can pay its people more money than the inflation that it's causing. And I think we're going to get a bit of that because the argument about deflation is the robots are going to be doing it all and they're going to be so cheap. You'll be able to make a cheap robot with robots and the robots that make the cheap robots will cause deflation. But that's a decade away, maybe even more. So to build your economy up that you can actually make this stuff when now you can't even make a light bulb. The capital that you have to pump in, and then the capital of the AI conflict. It's impossible for it not to be inflationary at a higher level than we're used to, or rather than we were used to up to COVID.
One recent example of a bond crisis was the 2022 gilt crisis, probably something you're very familiar with given that you are from the UK. Now, I think what Jamie Dimon was talking about is something similar in which we have a sharp rise in government yields, investors rush to sell bonds, and then central banks have to rush in to buy these bonds as a lender of last resort. Tell us more about this gilt crisis,
Well,
what we can expect.
yeah. Okay. So no, it's not going to be like that at all. What happened
No.
in the
Okay.
UK was that people in institutions saw that bonds were going to be falling. So if they had bonds, they were going to go up in value. Okay. And therefore they could borrow money cheaply and buy bonds. And the bonds would go up in value because the interest rates would come down, and they could borrow more money and buy more bonds, or borrow money and buy that good old vicious circle that financial institutions are really good at, and everybody's clever until it blows up and everybody dies, right? And that's what happened. All the pension funds, a lot of them, had levered up government securities to the moon on borrowed money that they borrowed. Because if you've got a government bond, you can say, could you lend me money on that? And they say, yeah, sure, of course, have some cheap money. Oh, okay, I'll buy more bonds then. Oh, yeah, that's great. And oh, I can borrow money on that. Oh, I'll buy more bonds, please. And you can lever up to the moon. Now, when interest rates are going down, you appear to be a genius, but the bend in the end kills you because you're levered up. And then when the thing goes up a little bit after that trend finishes, you're levered to the ears and you go bust. And that's what was happening because of a new government making, saying we're clever, and everyone panicked and interest rates went up, and all these people that levered up to their ears that had to have interest rates falling or at least not going up were all of a sudden getting margin calls. And the only way to bail them out was to, give them the money to make their margin calls. And that was a close one. But I don't think there's anything like that in the US. I don't know. I'm not in any American pension funds. But, financial institutions are quite good at believing that trends are going to continue forever and levering up until they blow up. I mean, that's what happened in the financial crisis. It was over levered and everybody thought they were clever until they weren't all of a sudden. But the government can always buy its bonds back and has been doing so, even though technically it's illegal. There's ways around that illegality. They can print their own bonds and then turn it into cash and then pay themselves. And they were doing that during the financial crisis. So you need money because you've got a deficit. Well, here's some government bonds. Oh, look, we've lent them to the Fed. Oh, the Fed's given us cash. Oh, we spent it. Oh, we've made some more. Oh, we've monetized those bonds and turned it into cash. You're not allowed to do that. No. Oh, we've done it. Oh, is anybody complaining? Well, no, we're the government. We're the ones that do the complaining and we need the money, so we're not going to complain. So that is the monetization of government debt is really the shortcut to inflation. And that's how you get hyperinflation. That's what the South Americans do. They don't bother taxing people. They just print the money and pay their people with it. And out it goes into the economy and they get inflation. And that inflation is the equivalent of taxation. Because they can't go around and say, give us a check for what you owe us. Because they say, no, I don't know what you're talking about. No, we don't do any of that. We don't do that tax paying thing. So they have to fund their governments by printing money. And that's why undeveloped countries with poor institutions have high inflation because they just print their money rather than go the taxation route. Does that make sense?
Before we continue with the video, let's talk about a topic that's been on a lot of precious metals investors' minds: how to generate income with your gold holdings. Most assets either generate income or rely on price appreciation. Gold has traditionally fallen into the second category. Our sponsor today, Monetary Metals, has found a way that lets gold do both. Instead of just holding gold and waiting for price moves, investors can now earn a yield on it paid in physical gold. Through the leasing platform, investors can earn up to 4% annually with yield paid monthly in ounces. That means your holdings increase in gold over time. The metal remains in your asset base and can be redeemed at any time. Thousands of investors are already earning monthly interest in gold through Monetary Metals, so visit monetary-metals.com/Lin in the link down below or scan the QR code here on the screen and make the most out of your gold today. Right, so in that scenario, by the way, I don't think North America has ever seen hyperinflation, but in that scenario, where would you go as an investor?
Well, they did see hyperinflation during the American Civil War. So where do you put your money in? So you've got to decide what kind of inflation is it's going to be. Now, I think it would be highly productive, i.e. they'll be pumping this money, printing it like crazy and putting it into productive assets, which is the least worst kind of inflation. And therefore, hard assets will be good. And, spicy assets like equities will also be good. Yeah, because normally at a certain type of inflation, equities hate inflation if there's no growth. But if you've got inflation and growth, which is what everybody who goes the inflationary route is trying for, and if you have inflation and growth, then you can, the stock market will be fine. And I think they'll be paying a lot of attention to the stock market, because if they blow the stock market up, what's left at this stage? Not a great deal. The financialization of American economy is its strength and its weakness, which is why you hear the people in government say, of course, we have the deepest pools of liquidity and Wall Street is the key asset. Yeah, it is. But of course, it's also quite a fragile one. So they will be paying a lot of attention to that. So there will always be a bit of a safety net there. But it's a high risk strategy. Don't make no doubt about that. It's a high risk strategy that can go wrong. And one day when they pull that lever, like they did obviously a few weeks ago, the market will not go up. But that day's not come yet, and it'll be sometimes away. As Diamond said, they can sort it, they can fix it, but why stop making the problem? Remember, they were going to stop running deficits. Remember how it was all going to be, cash flow positive for the American fiscal system, and the debt is going faster now. It's a bigger mess.
Does raise another bigger question, which is what could replace bonds in a 60-40 portfolio if you're one to believe that the structural bear market in bonds is about to begin or has already begun and is going to continue. Look at this chart that I have in front of me. This is the 10-year yield from the U.S. And in the last 45 years or so, yields have been coming down. The bond markets from the 80s to 2021 have been in a structural, cyclical bull market. That's come to an end. If you believe that this trend will continue, then bonds will not be favored by portfolio managers, and the 60-40 portfolio will have to be revised to something else. I wonder what that may be.
Well, no, I think that's old thinking, David. I'm sorry to say that.
Okay.
Because interest rates on government bonds are completely and utterly fixable by the government. They just buy them back and push that price down. Simple as that. That's what QE is. Right. So they can push that down. They can push it down to naught. They can take it negative if they want to. Look at Japan. Right. So that's not a problem. But when you do that, if you don't do it right, or you're not extremely clever, it turns immediately into inflation. Because all you're doing is flushing cash into the system, whereas before it was in something less liquid. Yeah. So you're by forcing interest rates down, by buying your own paper, which is monetization. Yeah, you suppress those interest rates as far as government debt is concerned, and anybody who holds government debt is going to make it out like a bandit. And there's more money in the economy, and there's more liquidity, and it's all going round and round and round and round. And of course, the price of housing goes up, and of course, the price of everything goes up, and that's what's called inflation. So if you say we've got this deficit, but we're not going to, monetize it, yeah, you get high interest rates. And yeah, it hurts and the economy suffers and you get a recession and then your money supply shrinks and then your inflation comes down and you're a lot poorer. With inflation, the value of money goes down, the price of everything goes up, and you're a lot poorer. Because basically it's the same outcome, but in a different guise. Yeah. So, if you're going to run deficits, the question is how long can you run them, and what is the level of sustainability? Now, what people are missing, and they need to think about, is if a government owes money to its own people, is that a big deal? And if it isn't such a big deal, well, there you go, because it's a liability of the government, but an asset of the people in that country. So it's the same as both sides of the balance sheet. Americans rich, government poor, right? Money coming up to your bonds yield is a reverse taxation. That's not so bad. The trouble comes when you're Argentina and you owe that money to people that aren't in your country. So it's all liability and no asset. Now, the American balance in Argentina, it's 100% basically is owed to people that aren't Argentina. It's all debt. It's all dollar debt, and they can't print that, right? In America, it's 30%, or the last time I looked. The American national debt is only owed to people outside of America 30%. So 12 trillion, that's the real national debt of America, the national debt that counts. But it doesn't matter if you keep making that number bigger. If you've got a runaway train, there is an end of the line. It might not be now. It might not be in 5 years. It might not be in 10 years. But you're on that. You're on that journey to the end of the line, and that's what Damon's saying. He said we've got to stop going down these tracks. Or if we're going to go down them, we've got to go a lot
Yes.
slower so they can build more of it.
Yes. Meanwhile, by the way, let's move on to another asset. Meanwhile, the UAE has announced that they're leaving OPEC. Now, the UAE produces 12%, according to the FT. They produce 12% of OPEC's total output. No doubt they've been angered by Iran's bombing and missile strikes on UAE infrastructure in Dubai, and other UAE members are not cooperating in terms of what they want for output. So Saudi Arabia wants one thing and the UAE wants another. So if OPEC starts breaking up, I'm not saying it will, but if they start breaking up one by one, what's going to happen to the price of oil?
I mean, I wrote a piece not that long ago saying, "Oh, it's going to go to $300 a barrel," and everybody said I was mad. And I don't think they think I'm so mad anymore. But I don't think it will necessarily do that here. It's going to get elevated. It's going to get elevated because Iran's infrastructure is going to get broken at this rate, and therefore the whole output of Iran's gonna be go through a very large hiccup. Even if it's all sorted out. So the supply is going to be supply issues, and that means that there's going to be price issues. And if you think that US is going to walk away tomorrow, then probably not such a problem. If you think the US is going to invade Iran, well, that's going to be interesting. And if you think it's going to sit there and run a siege, which is highly likely, well, Iran's output is just going to break. So there won't be Iranian oil for quite a long time. So that's going to be a shrinkage in scale of output. But, they will work really hard, everybody else, to supply the demand because they're going to get a great price for it. And a lot of these countries could quite like to have a budget surplus these days because they've worked their way into a budget deficit, like a lot of countries we know. So they will be knocking themselves out to supply. That's the glories of capitalism.
What's going on with gold and silver? They've been hovering around their respective ranges for about 2 months now.
Yeah, I think that's right.
Yeah, what is it waiting for?
Well, it's waiting to see what happens to, Xi and the PLA, I should think.
With what, sorry?
President Xi and the PLA.
Yeah.
Well,
Okay.
gold did what it did because next year in May, as you know, there was a lot of people worried about an invasion of Taiwan.
Okay.
And that was delayed because of the alleged coup that might have happened. The fact that the PLA didn't fancy losing 1 million of its people climbing Taiwan's cliffs. Yeah. Mm-hmm. So that has been delayed at least and maybe cancelled. And gold, at the same time as that kicked off, same time that the invasion seemed to be postponed, gold went down like a lump. Now, it doesn't mean that it's actually, delayed for good, but it is put off. And if President Xi gets back together with the PLA and they all make nice again, then gold will go on a run, because the gold is for war theme is all about Taiwan. Go look at the Taiwan Stock Exchange; it's just gone through the roof.
Wait a minute, this is
when the gold price fell, it counted to 10 and then went through the roof.
This is gold and silver, plunged late January, and excuse me. Reports of this coup among the PLA military leaders happened sometime around mid to late January. You're saying that the plunge in silver and gold coincided with news that there was a attempted coup in China?
No, that President Xi and the PLA had fallen out because he sacked 2 of his generals. And then the PLA said, well, how can we discuss the future when we haven't got the committee that discusses the future anymore?
Right, but you're saying that this fall in price was a result of that particular development.
Put the Taiwan Stock Exchange index on there.
Okay.
If you can.
Sure. Let's do this. Interesting. Wait, let me do this in percentage scale. Taiwan X. Yeah. Okay.
Yeah. Gold down, Taiwan up.
Right. Interesting.
Gold is for war.
Very interesting. Okay.
So now that Taiwan's not going to get shelled flat, yeah, it's indexes kind of you're reacting to that good news.
Well, I have to ask you then because let's talk about this mantra: gold is for war. Why didn't gold up? Why didn't gold and silver go up after the Iran war broke out? I think you've been asked this a
Okay.
million times. I'll ask you again. But
Okay.
yeah,
It's that the answer's in the question in a way. Gold is for war. So when you think you're going to have one, you buy it in. And when you're fighting one, you sell it because that's what it's for, selling to buy stuff. So like Russia's been selling gold recently. Well, it needed the money, didn't it? Yeah. And I'm sure Iran's been selling gold because it certainly probably needs the money. And nobody's going to take your paper, are they, during war? So you're going to go, oh, I'm going to have this fight. Well, China. Oh, we're going to have this conflict with the US. They're picking a fight here. I think we better buy gold. Keep buying it. Keep buying it. Keep buying it. Keep buying it. Because if we do have a war, we're going to have to start selling it to buy stuff. Because no one's going to take your paper. No one's going to take your IOU. They're only going to take gold. That gold is for war. Gold is the currency of war. It's the intergovernmental currency. So on the lead up to war, it goes through the roof. And during war, people have to sell it. And therefore, it's under pressure during war. And then after the war, it goes up again. Because during the war, there's been so much inflation. Everybody wants to get their hands on a hard asset. And bang, up goes gold. So during war, it's under pressure. Before a war, it goes berserk. And
okay.
after that war, it goes up as well.
So basically, it's now in the middle of a war, and this new conflict between China and Taiwan supposedly is canceled for now,
Yeah,
according to sources. Okay, so what are you doing with gold and silver? Is that a sell signal to you?
it's a watch signal. I mean, why wouldn't you watch it? And what's happening is the if you want to know what's going to happen to gold, it will go on a trend. Okay. And you don't really have a trend until the volatility drops. So as it compresses the volatility, the daily bars, if you want to look at it like that, once it goes back to normal volatility, you just look at the trend and you can see where it's going to go. And I should think it's going to be just going sideways for a bit. I mean, if you're a stacker, I, I think if you don't have a exposure to gold, it's a good time to dollar cost average. Have a bit next month, have a bit month before, after that, and have a bit another month. And you'll build up a position over a couple of years and you'll get a good average price. And then the chances are it'll go on another run. And if it does come down to 3,000, you'll be buying it all the way down, and you'll be buying it all the way across, and then you'll be buying it all the way up. That's the beauty of dollar cost averaging. If you want to plunge, well, you're a speculator. And if you're a plunging speculator and you don't know what the market's going to do, you shouldn't be doing it.
What are you most bullish on right now?
Nokia and nuclear power.
Seriously?
Yeah. Yeah, you see,
Why?
because Nokia is the biggest joke in town, apart from the fact that Nvidia just put $1 billion into them to build out 6G, because the Chinese infrastructure people aren't trusted anymore, and they're one of the few games in town that can build the infrastructure in mobile land and in 6G. And you can forget the 6G. Nvidia just put $1 billion into them. Ooh. And they're
Hmm.
European and they've got a stupid low valuation. And funny enough,
Yeah.
they're going through the roof. And of
Well,
course, everyone's going, aha, Nokia. Ho, 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 ho. Who'd buy Nokia? Apart from the fact that Nvidia just gave them $1 billion because they think they're great. AI in
yeah.
mobile infrastructure. So, and Fluoror, because they build clean, sort out nuclear stuff. And there ain't that many people out there that do that anymore. And boy, are they going to be building out nuclear like there's no tomorrow. And simply not, hey, I've got uranium. What do I do now? You better ring someone up to build a nuclear power station for you. Ah, who's that then? Ooh, not many people. And they're probably busy right now because everyone wants them. Oh, and their stocks aren't too expensive. Oh, that's rather good. I think I might buy their stock then.
How many of these companies pivoting to AI are you interested in? So
Well,
all
none
these
of the
Bitcoin,
expensive ones.
a lot of the Bitcoin miners have been doing that, including Marathon. And then all of a sudden you have retailers like Allbirds, a shoe retailer, pivoting to AI. And all of a
Well,
sudden the stock went up 700% overnight.
yeah, if you want that sort of stock, then sure. If you want to trade do crab racing, betting on crabs running up and down a beach, sure. But that's small cap, stupid trading, isn't it? And people love that. But I don't do. And even when I traded, I didn't muck about with that nonsense. But I'm not so interested in the expensive stuff, but there's some cheap stuff out there if you can find it. I mean, what about people that make cables? They're going to need a lot of cables. What about people that build nuclear power stations? They're going to be building them like no tomorrow. Yeah, because they're going to need that. Where they're going to get energy is the bottleneck. Energy is the choke point. Energy distribution, energy making it, all of that stuff is the big choke point. And there ain't going to be enough energy, full stop, period, until further notice. So anything that's in that zone is going to go really well. People that make server center cabling, which is, not your average cable, that sort of thing. People,
Okay.
copper, full stop, copper. There ain't enough copper before AI come along, and now it's come along. I mean, energy, they're going to have to make 10x energy in the next N years. 10x.
Right.
I mean, that just changes everything. So AI changes everything on many different levels. And if you're economically active, you're going to make a ton of money. If you're economically passive, yeah, they're going to work out well for you.
What do you think of all these tech layoffs happening? Meta's laying off 10% of its workforce. Microsoft is granting up to 7% of its workforce voluntary retirement. Nike's laying off 1,500 people. That's not a tech company, but a lot of companies are laying off people. What's going on?
Look, those companies were hiring people for non-existent jobs, and they were doing it for decades. And now, rather than hire a load of people to do nothing because it looks good on a spreadsheet, yeah, they are having to build out things that cost real money. So they're sacking their people that are doing nothing, working from home and playing computer games all day, and that's what's going on there. Now I can rephrase it to you. I can make that seem credible because you say, why would you pay that? What? In Silicon Valley, they call employees, wait for it, in the HR department, they call them stock. Let that sink in. So they're destocking. Those people are stock. They're not employees, they're stock. And they're just selling down their stock or not. They're just getting rid of their stock. Their stock is stale now and they're getting rid of it. I mean, gave me the chills when I heard somebody say, oh yes, we hire people because we need to keep our stock up. What? People are stock. Oh yeah, they stock. We've got to have plenty of stock. We don't want other people getting the stock. They were hiring people to keep them from working from the competition. Yeah, because they got all the capital in the world, and now they've got to build up big sheds full of NVIDIAs and buy nuclear power stations. All of a sudden, they can't afford stock. They've got to turn that into cash, and you do that by getting rid of it.
It was a matter of being leaner. It's not an indicator of the entire labor market at risk from being evaporated by AI.
Well, I mean, a lot of people have to ask themselves, how much work do a lot of people do? Yeah. Now, if the answer is 2 hours a day, AI is going to be pretty brutal to that organization, and they're going to have a lot less people because there's all sorts of ways of using AI to get 8 hours work out of somebody, or maybe even 80 hours work. I mean, I know programmers that are doing coding of 20 people. Now they spend £250,000 on AI doing it, but that's like 250,000 £2.5 million with the programmers, and they're doing it single-handedly because of AI. But what that will mean is that you'll get 10 times as much output, not a tenth of the programmers, because the programmers will be there. They'll be able to wield AI, the ones that are employable anyway, and they'll just make infinitely more code. I mean, the AI guys, they're cranking out a new model every 10 minutes. Why is that then, eh? Because they're using AI to do it. Their output is, no one's ever seen an output like these AI companies are putting out. Yeah, because they're using AI to do it. They are just the little boy riding the elephant.
If layoffs were to happen because of AI, the tech sector will probably be the leader in that kind of regime, being that they are the forefront. So. No.
It'll be the people that don't have a job that sit at a desk and claim that they do.
Say the tech sector will be
how many programmers
people off. Yeah,
how many programmers can you hire that can do the work of 20? You can hire as many as you can get. Mm-hmm. Yeah, because they're turning out stuff that people will buy.
Wow.
Yeah.
Cautionary tale for the rest of us. Hopefully not. Well, Clem, finally, let's touch on the Federal Reserve. The FOMC is set to meet tomorrow, Wednesday. So we're speaking a day ahead of the Federal Reserve. What are you looking out for? What's on your radar at tomorrow's FOMC meeting?
I don't know. All I know is the Fed is going to turn ultra dovish while claiming to be ultra hawkish. They're going to go on a complete printing bender. But I've
Even
got
if
to bring you back.
inflation is going to be a concern, like you've been talking about.
No, it's not going to be concerned. It's going to be a reality. They won't be saying it. They'll be saying deflation. Oh, deflation, deflation. Why are you saying that? And because I want to print money. Oh, okay. But what about if there isn't going to be deflation? Well, that would be inconvenient, wouldn't it? They're going to go on a burn. They've told you. I like to run it hot, says Donald Trump. You know, Jay Powell doesn't lower interest rates. He gets the police around his house. Yeah. And when the new guy comes in, all of a sudden the Justice Department isn't interested anymore. So you reckon that guy's going to come in and say, no lower interest rates, Mr. Trump. I'm a hawk. He's already said, oh, we want interest rates coming down because there's going to be deflation. What's the problem with that phrase? There's going to be deflation. Interest rates are coming down, just like Mr. Trump wants. Yeah. So anyway, you can imagine that somehow this is a super hawk that's not going to do what Donald Trump said, and he's taken on this job, and he sat down with Trump and said, "No, I'm not going to do what you tell me to do. I'm going to not lower interest rates. I'm a hawk, you know." No, no, it's going to be on a bender. Look, I'm going to take you back to AI. There's a lot of people are going to be absolutely in the gravy here, right? And there's no replacing you and me. There's people care about people. People want to know about people. They watch television to see people. They're not interested in robotics. And, it will just be a shift. In the same way as farmers thought that was the end of the world because they invented tractors. It wasn't, was it? It just changed. There's a big change coming, and it's going to be a massive amount of wealth created. And if you are economically active, or you've got something special like you have, David, you're going to do incredibly well. And if you haven't got anything special and you don't put your back into it and you just sit there and hope mummy will save you, I'm afraid it's going to be really bad.
Okay, well, I'm happy that great guests like you are continuing to make our show special. So thank you for coming back, Clem. Where can we follow your work for now?
Well, you can see me raving on my Clem Chambers Alpha on YouTube and on Substack. And, as you know, on your show, I've made some pretty outrageous calls and they've all come true. And I hope there's at least a few people that have thought good of it and remembered and maybe even made a large amount of money out of it. And, what's coming up, doom is not the answer. Fear is not the answer. Being on the defensive is not the answer. The answer is to be on the offensive and looking for the opportunities and being active and watching shows like you. I mean, how many? It's going to be 40,000 people in America watch this show. What about the other 350 million? Why are they watching you? Because they're passive. They're going to perish. Not people like who are watching your show, who care about the future, who want to know what's going to happen. They'll be absolutely fine. They'll be absolutely fine. And, the people that are fearful and inert and don't watch your show or mine or shows like ours, they're the ones in peril. And they can't be helped, can they?
That and the 40,000 people appreciate your wit. So...
and raise sharp repartee.
Yeah. Thank you to those of us watching the show right now. Please do follow Clem. He's got his own show. I'll put the link down below. So make sure to follow that as well. I'll speak to you next time, Clem. Appreciate your time as always.
Thank you very much, David. See you soon.
And thank you for watching. Don't forget to like, subscribe.